My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Markets seem reasonably priced until there's not enough money to keep buying the stocks that lead us higher. And that is the brutal lesson we're learning in the wake of the shocking Snowflake IPO yesterday, where buyers seemed indifferent to the share price. If you wanted to buy Snowflake, you had to sell something else, which triggered a sell-off in the NASDAQ, and that decline spread today, with the Dow dipping 130 points, the S&P falling 0.84%, and the NASDAQ losing 1.27%, as a lot of people call into question what they're doing paying such high prices. At Snowflake's peak yesterday, we saw the absurd spectacle of a stock trading at more than 100 times, not earnings, but sales. Yep, sales. Because there are no earnings, just losses as far as the eye can see. Don't get me wrong. Snowflake, it should not be about making money right here. It should be losing money. It's a hyper-growth enterprise where it makes sense for management to spend fortunes in order to dominate the cloud data management business. You want to win, you got to spend. Snowflake's not really the issue, though. CEO Frank Slootman will do everything in his power to deliver for shareholders. You heard that in the interview yesterday. He's got an amazing track record. I totally understand why people are willing to pay through the nose for a stock. I told you I liked it even as high as 125. But I clearly underestimated the demand because it swiftly went to 250 before pulling back hard today. All day today, I heard that the underwriters were the problem. They priced the deal too low. Wrong. The initial price range was 75 to 85. They priced it at 120. That's a huge move up. And I know exactly how they got there because I used the same reasoning. I think they looked at the gigantic demand. They decided to value it like the single most expensive stock on the market, which is Zoom Video, and figured Snowflake deserved a similar valuation based on prevailing investor sentiment and 100% revenue growth plus, no matter how insane that might be. Still, that $120 price tag, it's a stretch. As Zoom's growing a bit faster than Snowflake, and it's also outrageously profitable. It would have been crazy for the underwriters to price this thing higher than Zoom. They went as high as they could possibly go. Should they have flooded the market with more supply to hold the price down in the aftermarket? I don't know. When they sold 28 million shares, that's not chump change. Believe me, as someone who's been on both sides of the IPO process, the underwriters did nothing wrong here. The problem was with the buyers. They lost their minds. Some of this is because when a hedge fund gets a piece of the deal, they rarely get enough. If you want a position that's big enough to move the needle, you have to buy more in the aftermarket, and you're not as sensitive to price because of those cheaper IPO shares. If you got 50,000 shares at 120 and then bought another 50,000 at a very high price, call it 180, well, then you've got a $150 cost basis, which is expensive, but not totally insane. But there was too much demand for that playbook to work. Snowflake had the blessing of both Salesforce.com and Berkshire Hathaway, both of which got $250 million worth of stock at the offering price. Mark Benioff, the CEO of Salesforce, practically invented the cloud. He's got a fabulous track record picking winners. He got a piece of the Zoom IPO, too, by the way. Far more amazing was Berkshire Hathaway's involvement. Historically, Warren Buffett has never been a big fan of IPOs. He hasn't gone in one in more than 50 years, until Snowflake. When even Berkshire Hathaway wants a piece of something like Snowflake, you know it's going to be huge, which is why institutions were desperate to get a piece of it. So desperate that they sold all the other cloud stocks and FANG names in order to raise the cash they needed. All the high-flying momentum stocks got absolutely wrecked yesterday and today, which led to the vicious selling in the broader NASDAQ and then ultimately to the larger averages, although you see that they rallied back because that's where the cheap stocks are. Now, maybe you're wondering why this bothers me so much. After all, it's just one IPO, right? Wrong. Snowflake's merely the first in a parade of IPOs. Now, I've been warning you that this market's about to be flooded with deals, and none of them will be as good as this first one. We've been through this cycle many times before. See, I can tell you what comes next. We get a flash flood of expensive IPOs, but lower quality than Snowflake. In order to participate in them, money managers will need to sell something to raise cash. They don't have that cash sitting around. So what they'll do, well, they'll sell the similar super high flyers. Then they'll move into other tech stocks with more reasonable valuations and start selling those. Facebook, Apple, Alphabet. These are fantastic companies, but their stocks have run up dramatically. So hedge funds will sell them to pay for the next Snowflake, even though the companies are doing great and the stocks are really good. Sometimes it feels like I'm the only one worried about this IPO deluge. But today I saw a terrific piece of research titled The Implications of IPO a Go-Go. And I think they nailed it. I mean, this piece talked about how we're looking at a record number of deals, most of which will be underpriced before going to gigantic premiums. And when that happens, it will overwhelm the rest of the market, especially the digital stocks. Couldn't have said it better myself. Made me feel like I'm not alone. Then I looked at the date the piece was written. It was November 30th, 1999, 21 years ago. And it was by my friend Steve Galbraith, a genius, and he was at that point the equity strategist at Bernstein, the research firm. The massive NASDAQ top was building, and Galbraith spotted it. He was screaming for you to look out. He followed that one up with two more pieces. There was, quote, jailbreak, the coming flood of expiring IPO lockups on March 14th of 2000, right before the peak, and then jailbreak redux, no parole for prior good behavior on April 3rd, right after the saying that even the good ones are going to be sacrificed. Now, I was running money back then, and Galbraith's research was instrumental in getting me out of the market. We talked every day right before the top. Then I got the timestamp, then convinced me to go short in April of 2000 because he was so worried about the jailbreak. Oh, we had a great year. That said, I don't think we're looking at a repeat of the dot-com era or what happened back then. These companies that are trading now are much higher quality with legitimate great growth paths. But just like back then, we have an IPO problem. Like now, there were too many underwritings followed by tons of secondary offerings where insiders sold stock at any price because they were desperate to cash out. Of course, there are some big differences. This time around, the companies coming public are excellent. It's just that their stocks are too expensive. This time, there's less excess capital floating around the stock market, which might cut the IPO cycle short a little earlier than you expect. Finally, this time, the Fed is your friend, which makes it easier to own stocks. And that matters. That's the so-called no other alternative position. And who knows if we get a stimulus package. But the action today was very reminiscent of the past great and then boom and then bust IPO cycles. There was a movement internally under the averages to cheap cyclical stocks like Dow Chemical, which raised earnings estimates, or Caterpillar, which may be on the cusp of a turnaround, or 3M, where the fundamentals are clearly improving. They all did well despite the decline in the averages, and they're all much less expensive than what stocks we're talking about. Look, I am certainly not trying to scare you. I expected a correction, and that's exactly what we're getting here. That's why we've been raising cash for my travel trust. I've spent weeks telling you to do that. I think it's time to start putting cash to work. Instead of tech, though, I recommend picking up some of these historically cheap stocks that are being brought down by the entire averages, S&P selling, whatever it takes to get money in to own Snowflake. The bottom line, we aren't going to see a repeat of the dot-com crash, but when I see all these red-hot IPOs like Snowflake or JFrog or Amwell, I get concerned. Doesn't mean you should give up on the whole market. There are plenty of areas that still work. But as long as these deals keep coming, the high-flying tech stocks will indeed lose the luster they have gained in the last few years through no fault of their own. Steve in Maryland. Steve.
Hi, Jim. Booyah.
Booyah, Steve. What's up?
Hey, I wanted your opinion of Toll Brothers' chances of upward growth over the next 12 months. Stock symbol TOL.
I happen to like Toll very much, Steve. They've done a lot to be able. It's only a $5 billion company. They have really done a lot to make their organization lean, mean, fabulous homes, a lot of move-ups, really terrific as part of this stay-at-home economy. And it's at 12 times earnings. I think you've got a winner. Mike in California. Mike.
Hi, Jim. Big fan. Love the show.
Thank you.
I want to know about your opinion about a great e-commerce company, their executives, and the upside you see in the next 3 years. And, of course, if you think it's a buy. That company is GoDaddy.
GoDaddy's a good company. It's frequently overlooked. It's only a $12 billion company doing a lot of good things. You're totally involved with with web design. I mean, it's look, I happen to like Wix more. That's the one I think of when I think about web design. But I'd love to have GoDaddy on to talk about the stock. Let's go to Mike in New Jersey. Mike.
Hi, Jim. Mike from the Jersey Shore. Long time listener. Appreciate what you do for the individual investor.
Thank you.
My question is on a company I have invested into multiple times. It's a cloud-based business provider, Cloudera. Just recently released better than expected earnings, which was during the last pullback. And they also statements that were made a few months back by the company that they had received interest from a prospective buyer.
Right, but you see, we can't we can't buy stocks on the basis of what could be a takeover rumor. I will say this. It's an inexpensive stock, but this is in a business where they want fast-growing stocks, even if they're expensive, and that's the problem. Cloudera does not have the growth that other people are looking for, but they did beat the quarter, and I don't think it's dangerous. I historically have liked it down here. Let's go to Frank in Arizona. Frank.
Booyah, Mr. Kramer.
Booyah.
Also a big booyah to my Arizona Cardinals with a big road win in that toughest division in the NFL. But
that
I'm
could be
asking
it.
about now Wynn. Thank you, sir. Wynn Casinos. I'm looking at the tourism ban in China being resumed on the September 23rd with no restrictions, so no 2-week quarantine where 90% of their business comes from. China's Golden Week is October 1st through the 8th, where 75% of the hotels are already booked with 75% capacity. 25% of those are booked full.
Right.
So all signs to me look like it's time to go win, win, win.
Well, look, I think Matt Maddox is terrific. The stock is down more than 40%. I'm thinking much more, frankly, about Penn National because of some thinking that I've done about sportsbook and regional gambling rather than Chinese gambling. But I have no problem buying Wynn down here because Mr. Maddox has done a very good job trying to fight the COVID problems, probably more sophisticated than almost anybody I deal with. Okay, these red-hot IPOs, they're getting me a little concerned. But there's still plenty of areas that work. You know there's always a bull market somewhere. On Made Money tonight, could a telehealth company backed by Google be just what the doctor ordered for this market? I'm focusing on a company called Amwell Health after its first day of trading. Proof point, it's down about 20% for the year, but does it have a point to prove in this market? I'm going to be talking to the CEO. But first, does remote work have staying power? I'm going to give you some thoughts. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.